Hey, good afternoon, everyone. Marty Mazzora here, the 14th of May, Friday, 2021, with your weekly macro update. PWA index on your screen continues to move straight up, quite the trajectory. We were up 7 points to 48.98 this week. And that's a very, very good historic score. Okay, so I'm just going to jump right into it and go through the data points that I want to share with you. These will be data points that either move the needle in one direction or the other. We didn't have anything that pulled from our score this week. To the extent we had any changes, they were positive. And then I always throw in ones that I think are just worth looking at for the signals and the trends that they represent. So without further ado, retail sales, I've talked about base effects. Remember where we were a year ago, just in lockdown, right? So 51% year over year gain in retail sales is something that we should just completely disregard, obviously. So we want to look at things like the month over month figure, and month over month, we just barely budged. As you can see, we had a big move the previous month. Of course, that coincided with stimulus checks, and we don't have those checks coming in this month. So if you're just going to throw money at people or throw one-time incentives at people, you're going to get some pretty neat looking data. And then when those incentives end, then we get right back to the real world. So lots to crunch going forward, as we know. Very unique and dynamic situation that we live within currently. Consumer confidence, we just got the University of Michigan's survey out this morning. Bloomberg's weekly, that's still kind of a little bit flat right here. But interestingly, the University of Michigan's number came down noticeably. And kind of a surprise, right? Because, we're reopening, people are out, getting out and about, going out to dinner, maybe going to movies, what have you. So you'd expect optimism to be increasing, but what was really glaring were the inflation expectations, the expectations for real income going forward. And so when the consumer sees rising prices, they're going to lose some of that optimism about the future. Inflation expectations are important because they do say something about the potential for inflation going forward. And as you know, there are those competing narratives out there. And I am in the camp that we are looking at the probability of something more than just, cyclical short-term inflation spikes due to reopening, supply bottlenecks, and so forth. Got fairly into the weeds in this week's message on Wednesday, so if you didn't catch that, please do. Getting the inflation narrative right is going to be key, I think, to successful investing going forward. Weekly jobless claims came down again, a little further below that line that we drew right here, so we're at 473,000. So again, steadily declining. Weekly jobless claims is optimistic, obviously, in terms of what it says about the labor market. And speaking of the labor market, this is absolutely huge. This is job openings. And so we're at 8,123,000, and as you can see, that's got to be an all-time record. Hence this story, what the heck is going on with these many job openings with still a ton of people on unemployment. And really, there is just one overriding answer to all that, and that is unemployment benefits are unusually generous right now. NFIB Small Business Optimism Index, nice bump, but in the concern section, the number one concern is finding qualified people who are willing to come to work, and that's a big deal. Anecdotally, we all have our stories about vendors and places we frequent and what they're telling us about not finding workers. We need some cement repair work done around our house. My wife told me yesterday that, for one, the contractors, kind of this finishing stuff, who really specializes in that, first apologized because my wife had to call him like 3 or 4 times. He said, "Listen, I'll come out and give you a bid, but you're probably 6 months out." And he said, "The problem is we have about half our crew that we had before COVID, and we've got the jobs, we want them back, but nobody wants to come to work." So you get it. Those of you who follow the videos each week, a few weeks ago we took out the Caterpillar global sales number because they weren't updating it. It used to be on a monthly basis. We just got one for March 31st, so I'll see if maybe they're going to start giving it to us on a quarterly basis. So I added it back in. And as you can see, what a nice jump. And this is December right here. And then here's your March 31st move. So if that doesn't say something positive about, let's say just industrial activity throughout the world, I don't know what does. Just one data point on inflation, the break-evens. This is the yield on the nominal treasury versus the same duration treasury inflation protected securities, which is now a position in our portfolio. Inflation, compensation or expectations, and that's a concern as it relates to interest rates, as it relates to the debt bubble that I've been complaining about, and so on. So we're keeping a close watch on that and actually accommodating our what we believe is the right thesis on an ongoing basis to make sure we take advantage of what we think is a structural inflation setup. So we've been spending a lot of time on commodities on the macro update, and of course I talk a lot about it on the blog as well, and commodities are not a small portion of our portfolio these days. And so I've been pointing out this flag pattern, and then if you're going to have a price target the length of the flagpole. But last week I said, folks, we are going to see a correction in commodities, and I said any day now. Well, actually yesterday we saw quite the precipitous drop in commodities, particularly ag commodities, which are a pretty decent position for us. Number one, they're just really extended. We've got corn prices, at a decade high. Plus, we got a crop report yesterday for the U.S. that said that grain production or capacity is being invested in or picking up. They believe we're going to see some stockpile builds, and they were kind of, sanguine about the weather going forward. So corn, for example, I think took like a 5% hit. And today we bounced a little bit initially, but we ended up closing down. That was our only position in the red today, was our ag commodities ETF. Now, yesterday morning after that crop report, and then really expecting a correction, it occurred to me that, from these levels, we could see somewhat of a precipitous decline right here. Still quite bullish on the whole commodity complex going forward. So what we did yesterday morning is we jumped in and bought a really cheap put to protect our position in each portfolio. That position is trading just north of $18. We bought an October 16 strike put, which means we essentially bought some insurance on any drop below whatever that is, 10, 15% from where we are right now. I think the potential is for something bigger, but I like it long term. I don't think we're overweighted there. We thought if we'd spend what amounts to less than 0.1%, 10 basis points of each portfolio to protect a position that amounts to 8% of the portfolio, we think that's smart given the environment that we're in right now. So, but again, like the commodity story, I finished off this week's main message with making a brief case for maybe the beginning of something big and long-term in commodities, and I think that's a legitimate case to be made right here. But also, make no mistake, in terms of the industrial commodities, we don't really have to have structurally rising inflation when you think about all the infrastructure and green energy investment that's going to be going on. Inside that green energy is a phenomenal amount of mining of things like copper and other metals and minerals that are going to have to go on. So while we'll do well in those positions, if inflation continues to heat up, or as I expect it to come back down, but then steadily heat up, so to speak, on a longer term basis, that's a huge win for the way we're positioned, particularly in the very, very cheap, profitable mining stocks. But if we don't get that, but we just get trillions of infrastructure, as is promised in the U.S. and other places, well, then that's a trade that probably works out pretty well as well. So we're levered to inflation, but we don't have to have it to do reasonably well going forward. If we do have it, we probably do more than reasonably well going forward with hiccups along the way, like we had yesterday in commodities. Quick look at copper. Last week I said it would sure be nice to get some consolidation here. It sounds crazy, but we actually want this thing to come back and to take a break and consolidate those gains. And if we're right, we're going to see a steady move higher in things like copper. But this is just, again, as I keep saying each week, this is unsustainable. So giving some back is not only is it to be expected, it would be healthy right here as well. And then lastly, I mentioned that ag fund. Last time I did the technical analysis for you of each position, I drew this line right here and I said that's unsustainable and that we will get a correction. Well, we got it yesterday, and that's that gap down. Tried to bounce pretty nicely in the morning, but it didn't work. So from a technical perspective, I'm looking at this. We broke down below this trend line, so that would have been a sell signal right there. You got your sell signal right here on the MACD, on the RSI, and you can see typically when you hit these levels, you get some corrective action in here. Now, when we've corrected off these RSI levels in the past, notice that we were saved by this trend line that was established back in here. And look where we ended today, right on it. If we break down below here, then we're going to test this 50-day moving average, probably get some support in there. You break down in here and you're going to get these levels, which is where we bought the protection, where we think if you really penetrate down through there, you could see kind of a waterfall sell-off as all these people who have made all these gains begin to think twice about the future. Now, again, when it comes to ag, you've got weather issues galore. Brazil, which is huge in terms of global agricultural production, is looking at drought conditions right now. So I don't know that this is going to go down and break through there, but the potential's there. So in summary, the macro, general conditions look good. Our index certainly is scoring very nicely. Pushing 50 is a very high score historically. One thing that we have to always be cognizant of right here, and I don't think I can remind you enough, is that $10+ trillion of brand new money was printed since last year by global central banks. That is something that would have just been historically unbelievable. You wouldn't even have dreamt of that under any conditions. So there's lots to parse there, and it does say something about the future. If you missed the weekly message this week, go to it, or if you read it and you want to go back there again, it's really my 4 or 5 bullet points at the end where I talk about populism, and I allude to the fact that when you have strong, populist sentiments, that has huge impact on the political machine, if you will. So political policy and monetary policy then essentially molds itself to accommodate for that sentiment, because that can get out of hand in some very scary ways. And yeah, legitimately, we do have a wealth inequality problem. So it should be expected in terms of the willingness to run huge fiscal deficits, run huge government debt, with the notion that we can get away with that as long as we keep interest rates very, very low. It'll look good for a while. Financial markets will like it for a while. And the data and like our general conditions, our macro index, will look good under those circumstances for a while. But there's going to be an inflection point at some time in the future, and it doesn't have to be anytime soon. But the notion that we can continue just to create trillions of dollars of liquidity, dump it into an economy, and say it's okay if we keep interest rates low. Anybody who doesn't think that's going to show up in some real longer-term inflation, not hyperinflation, not 70s-style inflation, but certainly consequential inflation against a backdrop of really limited capacity. I think a lot about the miners stocks, the metals miners and so on, and the gold miners. Gold miners are incredibly profitable right here. They were really, really bloated between 2008, 2011, when China just went hog wild with construction, and they took on too much debt. Their balance sheets were upside down. They were just egregiously irresponsible. They got absolutely pummeled. They're very lean right now, and they don't seem to be inspired to aggressively build out capacity, and we're seeing that in the oil space as well. So again, we've got what I think are real inflationary forces. Not to mention, China's evolution to a consumption-driven economy, not an export-driven economy where you devalue your currency. No, it's now a consumer-driven economy where you kind of want a stronger currency because now it's your consumer, your own consumer, who you're focused on. So if the world loses, a population where a lot of those people worked in factories to give the rest of the world stuff cheap, while it'll get picked up in places like Mexico, which, as you may remember, earlier this week, we moved from the Japanese yen into Mexican equities, and there's a blog post there if you want more on that, which makes a lot of sense to me. But at the same time, just that evolution of China in that big population, we've got to view that as somewhat inflationary going forward. And so you just put it all together. And I guess in a nutshell, of course, I no more than anybody else knows what the future holds. But what you do is you just crunch the data, you remain objective, and you look at it and say, okay, what do probabilities say? And then if I take this position, why am I able to take it at such an attractive price right now? And that's the kind of thing we do day in and day out. So I will tell you what our assertions are. And I also want to share with you how we're challenging those and what we're coming up with when it's all said and done. It's all about probabilities. And in this world, it's about diversification and then really smart hedging, which I think is what we're doing with that ag futures position. All at the same time to deliver decent, in this environment, compounded returns, and try like heck to mitigate those losses at times like these as well. I'll stop there. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.